Hi there guys, Rukhsar Moin here from HBCS, and in this video we are going to cover International Financial Reporting Standard 10, which is related to Consolidated Financial Statements. So what IFRS 10 means? Let me answer. IFRS 10 answers one critical question. Who really controls a company? If control exists, consolidation is mandatory, no matter the ownership percentage. So in this presentation, we will break down what control means, how consolidation works, and how to avoid common exam mistakes. So in this presentation, we are going to cover its definition, scope, core rules, control model, exam focus, and recap. So let's start with its definition. IFRS 10 establishes principles for when and how a parent must prepare consolidated financial statements based on control. Now, let me tell you what does consolidated financial statement means. Consolidated financial statements present the financial position, performance, and cash flows of a parent and its subsidiaries as a single economic entity. What is its purpose? To show the true economic reality of a group, help users assess group-wide performance and risk. Its scope. What it covers? It covers parent-subsidiary relationship. What is parent and subsidiary? A parent is an entity that controls one or more other entities, that is subsidiaries. Control exists when the parent has power over the investee, is exposed to variable returns, can use its power to affect those returns. Ownership of more than 50% usually indicates control, but control can exist even below 50%. Now, what is subsidiary? Subsidiary is an entity that is controlled by another entity that is parent. What is the relationship in consolidated financial statement? Parent prepares consolidated financial statements. Assets, liabilities, income and expenses of the subsidiary are combined line by line. Another one is assessment of control. What is assessment of control? Assessment of control is the process of determining whether an investor must consolidate an investee by evaluating if control exists or not. Preparation of consolidated financial statements. What it excludes? Joint arrangements, associates, investment entities. Let's move forward. Its core rules. Recognition. Consolidate all subsidiaries that the parent controls. Its measurement. Assets and liabilities of subsidiary measured at fair value at acquisition. Non-controlling interest should be measured at fair value or proportionate share of net assets. How it will be presented? Let me show you by this Excel. Let's start with its format. Consolidated statement of financial position as at 31st December 2024. First, we will write non-current asset. Non-current asset will include property, plant and equipment, parents plus subsidiary. Then intangible, parents plus subsidiary, financial assets, goodwill, investment in associate, current assets, that is inventory, parent plus subsidiary, receivable, parent plus subsidiary, cash. Then total assets, equity, share capital, share premium. For parent only, group retained earning, we will do working for it, revaluation reserve, then non-controlling interest. Then non-current liabilities, financial liabilities, deferred consideration, contingent consideration, current liabilities, that is trade payable, overdraft, total equity and liabilities. So first we will draw group structure. That parent is controlling subsidiary. Parent has 80% shares in subsidiary. So the other 20% would be non-controlling interests. Okay. Working to net assets of subsidiary. Net assets of subsidiary should be taken at acquisition and at reporting. Share capital. share premium, retained earnings, revaluation reserve, and its total. Then is goodwill. Cost of investment, NCI fair value, net assets of subsidiary at acquisition. It will give us goodwill at the point of acquisition, at acquisition date. But if we less impairment from this, it will give us goodwill at reporting date. Then we are having non-controlling interest. Non-controlling interest, how it will be measured? Let's first study it. Non-controlling interest would be measured at fair value or proportionate share of net assets. How? Let me show you. Net NCI fair value, NCI share of post-acquisition reserve, that is net asset at reporting less net assets at acquisition into NCI percentage. It will give us total NCI. Okay. Its presentation. Group presented as one single economic entity, intra-group balances and transactions should be eliminated. Like this. I have shown you a consolidated statement of financial position. Let me show you its fair value adjustment. That is, at acquisition, assets and liabilities should be recorded at fair value. Non-current assets that are non-depreciable, for example, land, asset fair value if increase, then we will debit property, plant and equipment and credit net assets of subsidiary. If the asset fair value is decreasing, then we will debit net asset of subsidiary and we will credit property, plant and equipment. But if non-current asset is depreciable, that is, for example, plant or machinery, then if fair value is increasing, then we will debit property, plant and equipment and credit net assets of subsidiary. Same, if asset fair value is decreasing, then we are going to debit net assets of subsidiaries and credit property, plant and equipment. Now let's move forward towards non-controlling interest. Non-controlling interest should be measured at fair value method or net proportionate method. Fair value means full goodwill approach and net asset proportionate method is partial goodwill approach. How? Let's study. NCI is equal to number of shares held by non-controlling interest into subsidiary share price. Its entry will be debit non-controlling interest, debit group retained earnings and credit goodwill. For example, it was 1000, right? Then 500. Debit NCI, debit group retained earnings by 400 and credit goodwill by 500. Partial goodwill approach means NCI is equal to net assets of subsidiary at acquisition into NCI percentage. Goodwill impairment, for goodwill impairment, the entry would be debit impairment of group retained earnings and credit goodwill. Now, intra-group transactions. What are intra-group transactions? Intra-group transaction means intercompany sales and purchases, intercompany loan and investment, intercompany interest, intercompany current assets, unrealized profits on sale of inventory, and unrealized profits on sale of property, plant, and equipment. Now, we have consolidated statement of profit and loss and OCI for the year ended 31st December 2024. First is revenue, that would be for parent plus subsidiary minus intercompany sales. Cost of sales, parent plus subsidiary minus intercompany purchases plus unrealized profit plus excess depreciation. It will give us gross profit. Then admin expenses, distributions, investment income, finance cost, associate share of profit, that is profit share less impairment. It will give us profit before tax. After deducting tax, that is for parent and subsidiary, it will give us profit for the year. Then OCI would be revaluation gain, that is for parent plus subsidiary, will give us total comprehensive income. After that, profit attributable to parent and profit attributable to NCI would be added, which will give us total profits for the year. Let's move forward. Control model, that is step-by-step framework. A parent controls an investee only if all three are met. That is power, exposure to variable returns, and ability to use power to affect returns. Power means ability to direct relevant activities. Exposure to variable return means profits, losses, dividends, and synergies. If anyone is missing, no control means no consolidation. For example, parent owns 60% of subsidiary. Parent directs operations and policies. Subsidiary makes profit which would benefit parent. Its conclusion is power, variable returns plus link between power and returns. Subsidiary must be consolidated in this example. Basic consolidation entry would be debit share capital of subsidiary, debit retained earnings, credit investment in subsidiary, and credit non-controlling interest. Common mistakes. For example, assuming ownership percentage is equal to control no. Ignoring de facto control, that is less than 50%. Control should be above 50%. Forgetting potential voting rights, not eliminating intragroup balances, mixing IFRS 10 with IS 28 or IFRS 11. Its quick recap is control, not ownership, drives consolidation. All three control elements must be present, that are power, exposure to variable returns, and ability to use power to affect returns. IFRS 10 ensures group accounts reflect economic reality. That's all from my side. Thank you so much.